What if I told you there's a single investment that turned $900 million into $111 billion in 10 years?
The problem is that's what is in the headlines, but the dozens of companies that tried to do new things that lost all their investor money, they don't show up on the headlines. I've never met a deal that didn't sound interesting. And the idea, if I love the idea and I like the person, I want to put money in there. And that's a recipe for losing a lot of money.
A $5 billion market that a lot of advisors don't understand that it's really a fast growing market within our space.
This is not just a tax play. You want to outperform, you want to make money. And oh, by the way, there are tax benefits that get generated from these strategies.
This is the Rockefeller way, that the beneficiaries are really the future generations. They personally don't own anything. It's all in the trust documents, and then the trust is what owns all these assets.
I mean, indexing has been a thing since I started in the business 30 years ago, and someone came up with the idea, how can we make it better? And they came up with direct indexing.
Jim, episode 10.
Hey, Bryce.
2026, we're here. How do you feel?
I feel good. I'm excited for a new year and for all the things that the world will bring to you and me.
I'm excited too. All right, well, I'm going to ask you a question.
Yes.
What if I told you there's a single investment that turned $900 million into $111 billion in 10 years? How would you feel about that?
I would say that's got to be one of the tech giant companies.
Yeah. Well, maybe you read the outline because you are spot on. This is Google made a $900 million investment in SpaceX, and this was 10 years ago. And now, depending on obviously if and when SpaceX does an IPO, that stake could be worth $111 billion. So we've
good
got
ROI right there.
Good ROI. Yep. We got an article here that we're going to show that just talks through back in 2015, where it was the headline from the Wall Street Journal: Google nears $1 billion investment in SpaceX. So actually, Google did $900 million of that, and then Fidelity has an venture capital arm. They did $100 million of that. Those were the two that went in at $1 billion.
Wow. That's foresight. See where that's going.
Yep. So that turned in, again, 10% of the company, and that was at, again, in January 2015. And now there's rumors that SpaceX and Elon Musk has confirmed looking towards an IPO to hopefully raise around $30 billion or so. Valuation, we'll see, up in the air. But, there's feelers that maybe it goes to market at $1.5 trillion. And again, this would raise $30 billion for SpaceX. So this would potentially edge out Saudi Aramco's public listing in 2019, which brought and raised $29 billion. So this would make it like the largest IPO ever in terms of capital raising.
One thing I find interesting when you start using numbers like trillions, I don't think most people understand how big those numbers are. And what I used to tell the kids when I taught math is I'd ask them, how long do you think it takes for 1,000,000 seconds to go by? And they'd kind of think about it. And it's really a little over 11 days for 1,000,000 seconds. How long for 1,000,000,000 seconds to go by? About 32 years.
Wow.
For 1,000,000,000 seconds. How long for 1,000,000,000,000 seconds? 32,000 years. So remember, 1,000,000,000 is 1,000 bigger than 1,000,000,000. And that would shock the kids. And if you think about things like our debt as a country, right? A trillion is a big number, much bigger number than 1,000,000,000, and 1,000,000,000 is a much bigger number than 1,000,000. So just to give some clarity on how big a $1.5 trillion valuation is.
It's scary to think about especially when you frame it in terms of that, and then you think about our debt, and it's like, oh man.
Yeah.
But switching to a more positive note, if this goes to a 1.5 trillion, and if they cash out here, this would be a 123x return. So 123x bagger is very good. 123x bagger on a $900 million check is extremely good. So, and Google already reported an $8 billion gain on their Q1 financials, Q1 2025. That was 25% of the company's total net income. So at that point in time, SpaceX was raising some capital early last year. And so there was a one-time $8 billion gain that they had to recognize on their books for GAAP accounting.
And this is really the only game right now for SpaceX, right? I mean, they're having some people trying to compete, but it was NASA and then SpaceX.
Yep.
No one else really.
Yep, spot on. So right now the launch services is less than 30% of the revenue, but it's 90. They have 90% market share. So you got Blue Origin from Bezos, right? You've got some other ones that are trying to compete, but they've got a 90% market share. And like you said, they've essentially replaced NASA. But the bulk of their revenue now is actually Starlink. And so Starlink has that. I don't know if you caught that they've got a deal in place. I believe it's with T-Mobile that they're going to actually look to compete against the Verizons of the world. And so they're going to actually be able to provide like a competing cell phone service in addition to the Wi-Fi service that they provide. So Starlink has really been turned out to be a huge business. And the rumors of that was about this year that they're going to do about 22 to 24 billion in revenue. So I mean, at 1.5 trillion, if they hit that, that's 63 to 68 times forward revenue multiple.
Wow.
I would love my business to be valued based off of that.
Yeah.
Our business to be based off that.
Yeah. I was going to say your business ties to my business, so that would get me excited too.
So takeaways for entrepreneurs, I think, I go back to just venture capital portfolio creation and structuring. That in order for venture capital to make sense as an asset class, you need to hit home runs. Now, granted, this is a grand slam, not just a home run. Ideally, you're trying to get like a 10 bagger, not a 100x bagger, but you're going to strike out a lot. So I always go back to talking in the framed entrepreneurs when we're talking about venture capital, which this was part of Google's, venture capital portfolio. They're making, tons and tons of bets, and that set a budget and then get at least 10 different bets, knowing that several of those are going to strike out to zero, and you just hope you have one 10 bagger. And so then you're hoping your net IRR over a decade is about 20%, So that's kind of a takeaway for entrepreneurs is that sure, venture capital could make sense, but where I see a lot of entrepreneurs fail here is that they have a buddy, a friend, so-and-so just sold their business, they're going to start something new, and they write one check or two check, 25 grand here, 50 grand there, and they got a hodgepodge of maybe 3 or 4 deals, and they all strike out, and then they're really disenchanted. And it's like, well, there was no rhyme or reason. You were just writing checks based off of vibes, and so there was not really part of a intentional portfolio construction.
When I hear this, it almost makes me cringe a little, because when you see a home run like this, it fuels the spirit of entrepreneurs wanting to invest in venture capital, because that's the most exciting thing. If you're early on SpaceX, that would be wildly exciting. The problem is that's what is in the headlines, but the dozens of companies that tried to do new things that lost all their investor money, they don't show up on the headlines of the paper. And I have to tell you, and with being 30 years as an investor, the thing that gives me the most concern is when I see a pre-revenue deal. So when there's a pre-revenue deal, that goes on the back burner, and that does not excite me. It's interesting. A guy I know here in town, Peter Thomas, who's a very successful guy. I met him through my friend Joe Polish. He built the Four Seasons up in North Scottsdale, and he has a storied history of being a very smart investor. And one thing that I heard him say not long ago is that he used to, when someone would come to him, a friend, hey, I have this investments, and he'd look at it and he'd go, oh, it's only 25,000. So he'd throw that. Oh, it's only 50,000. It's only 10,000. And he said after a while, he started adding up all these deals he threw money in that he lost money at. And so he decided he was not going to invest in anything that didn't get his full attention. So he said what he does now is if someone comes to him and says, hey, I want $25,000 for this startup, he says, how much are you trying to raise? And they might say 6 million. He goes, I tell you what, I'll take the entire 6 million or I won't give you anything, but it's got to go through my team and my process. And he said that prevents him from doing all these little dumb deals that clog up his inbox with K1s at the end of the year and also usually are not vetted, and he loses his money. So that's kind of some of my thoughts on VC.
Yeah. Wow. And I hope that I'm not a big VC guy. I know we've talked about this in the past, just because it's with how much long the money's been tied up, the DPI, which essentially is the return to investors. A lot of it's been paper returns over the last few decades, and the NASDAQ's been performing essentially just as well as venture capital as an investment asset class, both all the liquidity. So I know, as much as I dream about a 123x return, right now as Warren Buffett, as I'm saying, I'm just watching the balls fly by, and I'm just, waiting for the fat pitch, because to me, it just sounds like too much headache, too much work. And I don't want to put the time and energy into like building that type of portfolio out.
Yeah. And you know what? It really is about the allocation and making sure that you're doing it in a disciplined way. And if you're going to put money in VC, whatever it's going to be, 3%, 5%, whatever the overall portfolio, you got to stick to that and not just throw money at every deal that sounds good, because I've never met a deal that didn't sound interesting. And the idea, if I love the idea and I like the person, I want to put money in there. And that's a recipe for losing a lot of money.
Yep. Awesome. All right. Well, now we're going to transition into a $5 billion market that a lot of advisors don't understand, that it's really a fast growing market within our space. And really the thesis here, right, the sales pitch is, hey, investor, what if you could get above average market returns? You could harvest substantial amount of tax losses, and these tax losses can be used to help offset your gains from your business sale, gains from a real estate sale, even gains from a crypto sale, and keep you very well diversified. So this is what we're calling enhanced direct indexing, and this is kind of a big space that's really blowing up within the advisory world. And so I wanted to make sure we can clearly communicate to some of the trends that we're seeing and why you and I, and eventually we'll talk about this, are actually investing our own money in this, and this is how we're getting our stock market exposure.
Yeah, and I think it's good to take a step back and start with direct indexing, if it's okay if we start there. Direct indexing, which has been around now for a while, and it's got a lot of traction, and I think most brokerage houses and most financial advisors have access to direct indexing. So I'll start first. What's indexing? Indexing is buying things like the S&P 500. You're buying an index, low cost, getting exposure to a certain market. So what is direct indexing? Let me take the S&P 500, for example. If you own the S&P 500 and let's say an ETF, every year, not all the stocks go up and not all the stocks go down. So let's say in a good year, of those 500 stocks, maybe 450 go up, but there's always going to be a few that go down. So let's say 50 go down. In a perfect world, what you would love to do as an investor is hold those 450 so you don't create any gains and just sell the 50 that lost money so you can use those losses to offset other gains in your portfolio. That's the idea. So what they came up with is this direct indexing. So very simple way to think of it is you buy all 500 stocks in the S&P 500, and then you can sell the 50 that went down to create the tax losses, but not sell the 450 that went up. There's one nuance here, and that is, let's say you had Pepsi in your portfolio and you sold it. You can't buy back Pepsi right away for 30 days. It's the wash rule. Instead, you can get similar exposure by buying Coca-Cola. So they would sell, if they sold a company that was down, they would buy a similar or a replacement company in that type of industry so that you keep the same exposure in your index. And that actually has shown to be meaningful in the tax savings when you're building a portfolio. So that's the direct indexing piece. Anything you want to add to that?
No, I think just to put some numbers behind this. So direct indexing is gaining a lot of traction, and it's been growing at 37% per year is some of the data that I've got here over the last 3 years. And interestingly, only 14% of financial advisors, according to one source, are actually actively recommending it. So it's still up and coming, but to your point, it's out there. 86%, I guess, of advisors don't use it or don't understand it. But I think most entrepreneurs who are engaging in our content and that we're talking to have access to it because, to your point, most well-respected large investment management shops have this as an option on their platform. So I love the way you described it. I think now, Jim, go into a little bit more about the enhanced direct indexing, which again is a subsegment of this direct indexing, and break that down.
So enhanced direct indexing, the easiest way I can explain it is in a direct indexing scenario, you're going long in all the investments. So you're buying those 500 stocks in the example that I gave. Well, when you're buying 500 stocks and you have your gains and losses, in addition, they short stocks. So the definition of shorting, as you may know if you're listening, is that you're betting against the stock. So when you go long a stock, if it goes up in price, you make money. If it goes down in price, you lose money. If you're shorting a stock, when the price goes up, you lose money. When the price goes down, you actually make money. So they're doing that in a much larger scale, and then they're doing the same thing as direct indexing. They're selling the losers to create the tax losses, and they're holding the winners so that they don't create those gains and create more tax problem for you. In addition, they use leverage at a varying degree depending on the strategist and what they're trying to do. But by using leverage, they're amplifying the losses that they can create to pass on to the investor to offset things like capital gains. So if you think about it, it's taking that direct indexing and just making it much more powerful in its actual execution and how it's working for an investor.
Yep. And I think another word, we were calling this enhanced direct indexing. I've seen other people call this leveraged long short funds, but these are separately managed accounts that, to your point, are adding on these extra bells and whistles. Now, why are these bells and whistles important? Now, historically, really based off of the last several years, these funds have really outperformed their benchmarks, whether it's the Russell 1000 or Russell 3000. But on top of that, we've seen the tax losses that can be generated span from 30 to like 95% within the first 12 months, meaning you put $1 million in, hypothetically, you could get capital gain or capital losses, I should say, worth 320 grand up to 940 grand, depending on how much leverage you're willing to take on. So again, the tax losses could be very substantial, but most importantly, the performance been very, very strong as we've looked at these over the last several years.
Yeah, that's one important point is that these are strategies where you're trying to make money or actually trying to outperform markets. This is not just a tax play. You want to outperform, you want to make money, and oh, by the way, there are tax benefits that get generated from these strategies.
Yep. And I think it's very important to note that the losses that are spit off here are capital losses. So capital losses can be used to offset other capital gains, whether short-term or long-term capital gains. Those are derived when you sell your business, you sell real estate, you sell a stock, when you sell crypto. Those are capital losses. These losses cannot offset your business income. They cannot offset W-2. Technically, you can offset $3,000 a year, but that's a rounding error. So that's really important to note because as we talk through these with entrepreneurs and with our investors, it's making sure that they're really educated on like what losses can this actually offset. Because if you don't have this type of income, then the value from a tax perspective isn't as valuable. Now, there's still great value from a performance perspective because they've performed so well. But again, from a tax perspective, it's really important that we're matching up the type of income we have and then trying to match it with other losses of that same exact type to offset
I want to
it.
double down on that because it's something that entrepreneurs miss a lot. And you've done a good job just in our private conversations talking about this is when you're doing a tax plan, the first thing you have to decide is what are you trying to offset? What is your tax issue? Not just throwing, shotgunning the thing, but figuring out, do you have portfolio income you need offset? Do you have passive income that you need offset? Do you have active income that you need offset? That's going to dictate what strategies or tactics that you might want to consider based on your situation. And often entrepreneurs think, well, my buddy's doing this, that, and the other, so I should do the same. Well, it depends. You might not be trying to solve the same problem.
Yep. Totally agree. So who's a good fit here? So if you're an entrepreneur and you are expecting a liquidity event, whether a business sale, an ESOP, maybe you want to rebalance your crypto portfolio and you have a lot of unrealized gains. Maybe you don't want to do the 1031, the buy, borrow, die strategy we talked on the last podcast, and you want to instead, recapitalize your balance sheet. Well, that's where these investments can make a lot of sense. It gets you exposure to the stock market as the underlying asset class. It's performed very well historically. And on top of that, you can accumulate a lot of losses. Now, if you don't use those losses in that year, they do roll forward. So you carry these losses on your tax return until you have that capital gain event. So that's why we're seeing these used strategically to pad losses ahead of a liquidity event that we're forecasting in the future.
That's so smart. And it's something that a lot of entrepreneurs don't think about. And I can't tell you how many times I've been speaking at an event and an entrepreneur runs up to me and says, hey, I just got an LOI. I need your help. And I always think, 3 to 5 years before an exit is when you really start wanting to think about your exit and how to plan for it. And most entrepreneurs who've had more than one exit, they always say my first exit, I was so dumb. I did everything wrong. I didn't do anything. And then they learn and then they realize that pre-planning prevents those problems.
Yep. All right. Well, let's put some examples behind this. So this is going to be the behind closed door segment. And so let's jump into a few specific case studies. The first is going to be a tech entrepreneur who has a concentrated position in Bitcoin, and they wanted to diversify out of Bitcoin and into some more income generating assets because the business is at a stage where it's just kind of run rate. And so they're looking to really live off of the portfolio they've accumulated. The next example we're going to go through is an entrepreneur that's got an LOI and kind of talk through some of the planning that we've done and how we've incorporated these strategies into this. So to set the stage on this first entrepreneur, let's assume that the Bitcoin position is north of $12 million. And the goal is, how do I sell the least amount of Bitcoin that has very, very low basis? Because I was an early adopter. I want to sell the least amount of Bitcoin, but I need to generate $50,000 a month of after-tax income. So the process here is, well, let's reverse engineer in terms of if it's $50,000 a month of income, let's gross that up for taxes to then get us a monthly number. Let's then run that through a Monte Carlo analysis to figure out how much money do we need to deploy to generate this amount of after-tax cash. And really it said, hey, 9.25 million is how much we need to deploy in a diversified income portfolio or income generating portfolio to generate $50,000 a month, over a long period of time after tax. So now, okay, if we need to realize $9.25 million, I either can sell over $12 million of crypto, $12.5 million is the exact amount here, pay my taxes, and then I'll end up with 9.25. Or what I can do is take the $9.75 million of Bitcoin, sell it, take the proceeds and invest into one of these enhanced direct indexing or leverage long short funds. And if I do this and time it appropriately, that will create a substantial amount of losses that I can use to offset my capital gains. And I can do this in a zero beta account, essentially meaning I don't take market exposure. I can get between like kind of a -4 to plus 12% rate of return. So it allows me to then essentially pocket or hold on to at least $3 million more of Bitcoin to let that ride. Because again, my goal is how do I sell the least amount of Bitcoin to generate this amount of passive income.
Yeah, the people who love Bitcoin really love Bitcoin. But it's a powerful example, and I love how we're creating this scenario where we're solving this problem in a very specific way. How can we generate the income that the entrepreneur wants in a way where the entrepreneur can retain as much of Bitcoin as possible?
Yep. And so again, this gets them broader diversification, which we love because now we're selling some of the Bitcoin, which is a very concentrated piece of the portfolio. Now we're diversifying that into an equity sleeve. So there's good diversification there. Great tax benefits because of the enhanced direct indexing and tax loss maneuvering we've talked about. And also it kind of de-risks the portfolio because the Bitcoin is very volatile. But by putting this into a zero beta sleeve, again, we're constraining our rate of return there, capping it, but also we're hedging the downside. So again, the spread is generally between like a -4 and a plus 12% rate of return. But at the end of the day, that's okay because we're insulating this part of the portfolio, taking some chips off the table with the goal to increase the amount of passive cash flow that we can generate.
And if the entrepreneur has other assets and doesn't worry about the fluctuations, they don't have to do that zero beta investments. They could have it float, because this investment without that zero beta is going to fluctuate. I mean, and when you're trying to outperform the markets, you're going to have fluctuations up and down.
Yep. All right. So let's just we got a visual here. We're going to put on the screen. Just shows the concentrated crypto workout. So again, in the orange, you'll see without any planning, we'd have to sell $12.5 million of Bitcoin. We'll have to pay essentially $3.3 million in taxes. Or you can use one of these enhanced direct indexing, $9.75 million is how much you'd have to sell. And again, your tax bill would be substantially less there. So save about $3.2 million in taxes, better diversification, great performance, and now you can redeploy into an income generating portfolio.
Save $3.2 million in taxes?
Yep.
Wow.
Let's go now to, and that works whether it's crypto, concentrated stock position. We see some entrepreneurs that got into Tesla at $50 a share, or Nvidia. It's the same premise, right? And same thing, it can work with real estate. So crypto is just an avatar here. But again, it's any type of concentrated position like this. It allows you to get diversification in a tax efficient workout. But let's now go into, again, another case study here that we're working on, $70 million LOI for an entrepreneur. Now, this entrepreneur did some really good planning in that, and just kind of to set the stage here, we've got $70 million LOI. Kind of what we're expecting here is about 3% deal fees off the top that you got to pay your investment banker, your M&A attorney. There's a phantom equity pool, about 13% that's going to get paid out. You're going to roll 20%. So the private equity buyer wants him to roll 20% of the proceeds into the new company. So from that $70 million pre-tax and pre-anything, $44.8 million is where this entrepreneur's waterfall starts, right? Because again, deal fees go off the top, phantom equity gets paid out to your key employees and executives off the top, and then your rolled equity leaves off the top. So we're starting at $44.8 million. So from here, our capital gain and our capital gain taxes would be around $11.5 million. So if you do no planning, you'll end up with around $33 million after tax. Cash-free, debt-free transaction, very common in the middle market here. There's $5 million of cash on the balance sheet. And since it's a pass-through entity, he's already paid the taxes on that cash. So that kind of joins the party, so to speak. So he'd walk away with about $38 million after tax if there was no tax planning done. And again, this is crazy because a lot of entrepreneurs say, $70 million LOI. And then what we just said is, okay, if there's no planning and after the deals, the expenses, the rolled equity, all of that, you'd walk away with $38 million after tax. And so then this is a big thing that a lot of entrepreneurs don't realize this until and we build waterfalls for them to show them where all the money's going. But there's a lot of holes in the bucket, so to speak, when you're selling your business. A lot of people got to get paid along the way, and rolled equity, and taxes, it's not all that it's made out to be, at least with the headline.
I've seen entrepreneurs, I can think of two business partners, they had a 9-figure exit, so more than $100 million. They split the company, but then they had money that rolled forward that ended up worthless because the company was run into the ground. They had to pay taxes with no planning. And by the end, the amount they had left would be shocking to most people that heard that they had a $100 million exit.
Yep. Yep. So within this case study, there was some good planning done. Did some irrevocable trust planning, got the business out of the taxable estate, or 80% of the business out of the taxable estate, into 2 separate trusts set up for benefit. Did some spousal lifetime access trusts at a $6 million valuation. So again, great estate planning. We value the business at $6 million 4 years ago. Now it's worth $70 million. So that all of that growth, that $64 million of growth pre-tax, is all out of the taxable estate. So we're layering some strategies here, but it's an important case study. And this goes to your point of the importance of having foresight, that if you're going to build your business to sell, and if you're married, you're going to have over $30 million, or if you're single, $15 million. Now that we're in 2026, it's important to do some of this advanced estate planning ahead of time to mitigate estate taxes if you're trying to maximize how much money you're giving to your heirs and it's not all going to a charity.
Yeah, and as a side benefit, this creates a lot of asset protection too.
A lot of asset protection, exactly. So now as part of this, again, we talked about $38 million after tax, right? Kind of the waterfall. Well, part of the idea is, hey, move $30 million into this leveraged long short strategy, again, into a zero beta strategy. We don't want to take on massive market risk here. At this stage, we are very wealthy. We want to be well diversified, but the expectation is that depending on the date of the sale, this could generate anywhere between $20 to $28 million of tax losses in the very first year. So some outstanding tax losses could be generated by taking the proceeds and investing them in this type of tax efficient strategy. Now, that combined with using a charitable lead trust, this client, it's really important that they tithe every single year. So there's going to be a $5 million go to a charitable lead trust. Those two strategies combined really knock down the amount of the tax liability here. So the $5 million in the charitable lead trust will save about $1.3 million in taxes, whereas the if we do the enhanced direct indexing, that can save about $7.4 million in taxes. So now all of a sudden our $11.5 million tax bill goes down to about $2 to $3 million.
Yeah, I mean, it's incredibly powerful. This is something you don't want to do alone. This is something you've got to have experts in your corner to try to navigate this kind of planning.
Yep. So we got a kind of final visual summarizing this. $70 million LOI here shows the net to seller. It also goes through in orange if we do no planning, about $11.5 million tax planning. With this multi-generational strategy planning, with the tax loss planning, less than $1.3 million of kind of total tax planning that can be used here. And it really depends on the rolled equity and what you're going to do there. But just stacking some of these strategies, but highlighting the value of the leveraged long short as an investment vehicle to get better diversification within your portfolio and to generate substantial tax losses for you.
Yeah. And hopefully get really good returns over time.
Yep. That is definitely the goal. Okay, well, let's talk through one thing actually, just before we move on. I think it is important to note is the estate tax savings here too, because as we mentioned, all of the value of that business that was moved into irrevocable trust is going to grow and compound outside of the taxable estate. And so the value of that is quite substantial. And so if we assume, right, that about $42 million of this, now it depends on the value of the rolled equity, but at a 40% tax rate, this could save $17 million just up front in estate tax. That just shows the power of doing this case we did spousal lifetime access trust, but really irrevocable trust planning is so important when you're looking to transfer the most amount of wealth to future generations.
And this is a snapshot in time. If this entrepreneur lives for 20 or 30 more years, that could be 150 million, 40% of that. Now we're talking big money.
Yep, exactly. And that is how you build generational wealth. Because again, now that you've got these generational, this dynastic trust structure, you have a liquidity event, the proceeds go into these different trusts. Now you make different investments, right? These investments are all titled in the name of this trust. So yes, you can access these trusts based off of the distribution language and the beneficiary language. So you have access to the money, but the ownership and the title always stays in this trust. That is what allows these trusts to grow and compound for future generations and never be subject to estate taxes. So when you hear about like a family bank and the Rockefeller way, it's really this. This is the Rockefeller way, that the the beneficiaries are really the future generations. They personally don't own anything. It's all in the trust documents, and in the trust is what owns all these assets. They're just a beneficiary of the trust. They can tap into the trust for, whatever the entrepreneur or the creator of the trust wanted them to tap it into, whether it's ongoing income, whether it's, to business formation, whether it's incentive language to match earnings, to be a productive member of society, to propel your vision with Christ or the Lord or church, whatever it may be.
It's interesting that I have a friend who's the grandson of a very wealthy person, and he's always expressing frustration that he can't get access to all this money that's earmarked for him. So I see that, and he's actually a great guy, and I think he would be very responsible with the money. However, I see the flip side, which his grandfather is saying the way generational money gets wiped out is you allow the grandkids to get their hands on it. And guess what? They don't always do the right thing with that money and they blow it. I also think about my own situation when I look at this and I go, wow, we don't have kids. I don't have to worry about this. I'm one-upping Warren Buffett, who I think he said 99.5% of his net worth is going to charity. Right now we're 100%. However, with your boys growing up, I tell this to other friends of mine, if your kids make a good impression on us, who knows? They could be cut into the estate. And that way, that means when we're older, visiting us, bringing us gifts, doing nice things, just to plant that seed.
Interesting. So you guys, so you and Mimi are open for business is what you're saying.
Exactly.
That anybody who has children, so any children out there in the United States that are parents, if you want to tap into the due estate, how do they get in touch with you? How are they going to do the dog and pony show?
Let me clarify. Not any kids. I'm going to get 1,000 letters this week. Not any kids. Kids of people that I have faith are good parents and that I know personally. So like you and Leanne are incredible parents. I think those boys are going to grow up great. Hey, when I'm 80 or 90 and I'm lonely in the nursing home, if they show up and they spend some time with me, hey, that goes a long way. I'm trying to create my future, like who's going to take care of me, who's going to show up and visit when I'm alone and no one cares anymore.
Sure.
And if I get that, hey, I'm open, like you said, open for business. I'm ready to, take some of that estate and make it available to, kids like yours.
Okay. I'm going to remember this. So when Uncle Jim is really old,
yes,
the boys are going to come in with a 1-page document and a pen, and they're going to say, Uncle Jim, you sign right here. Here's some cookies. There may be laced with some other things, but you sign this and here's the cookies. And,
you're probably going to be my trust protector. So you're going to be there to make sure that doesn't happen. But like I said, we carve a little bit out, maybe not, we still want to give a ton to charity, but I'm joking, of course. But it is nice. There is a relief that I don't have this burden of kids and grandkids and all that stuff. Although I think it's a beautiful thing when people want to be remembered and their kids have opportunities because of them. It's just not going to be us. The money we build is all going to go to charity, and that's going to be a cool thing also.
Yeah. And I see a lot of, sometimes it can get very overwhelming for entrepreneurs, and some entrepreneurs are like, hey, I had nothing, and so I want all my money to go to charity, even if there is a substantial amount of wealth there. Or oftentimes maybe we'll see, hey, here's a base amount that maybe it's $1 million and it's something that is going to get the kids rocking and rolling, but it's not going to be enough to do nothing the rest of your life, like Warren Buffett would say. But then also we've seen a lot of entrepreneurs want to really create that family bank, that dynastic wealth, and there's different committees, whether it's the investment committee, the giving committee, right? There's all of these different committees, distribution committee. And so then there's very clear guidelines on, designing this trust with a lot of intent that's going to be around for 100 years and providing frameworks on how different committees and different family members can get involved in these committees. So,
I wish you wouldn't have said that, because then that gets me thinking like maybe we should think about a foundation that goes on for multiple generations so that the principal continues to grow and we can help more people. So maybe my fractional family office linchpin partner, Bryce Keffler, might push me in that direction. Today, we're too young to worry about that. And if we died today, we'd be happy that we'd help a bunch of people out. But that is something to think about.
Yeah. What does Make Rich Real mean to you and Mimi? And I think really thinking through that in a little bit more depth.
Yep.
All right, let's transition to the fractional family office floor. This is where we always talk about just transparently stuff that you and I are doing, how we're investing, what we're doing, how the business is doing, or what we're doing within the business. And today, I think given the topics, it's probably important to put a disclosure that we're eating our own cooking when it comes to these leveraged long-short funds or the enhanced direct indexing funds, that both you and I are getting all of our market exposure through these exact funds.
Yes, and I think that's interesting, eating our own cooking. And I'll tell entrepreneurs a lot, just because I do it doesn't mean you should do it. And there are things that other entrepreneurs do that are friends of mine, clients of ours, that I say, I wouldn't do that. And they go, why not? Well, because my situation's different. It's not because you're making a bad decision. Yes, we are involved in this. We're invested in this. This is really good. Something that there is no way for me not to pay is the 453A on the installment sale through the ESOP, which is tough. So if you do an installment sale and you have more than $5 million, it's a $5 million exemption per person. The government and the IRS, and this is something that I think is pretty egregious in the tax code, if I'm going to be honest about it, and that is that you have to pay a government interest rate applied to the 20% capital gains that you would have paid had you gotten the money. So I'm saying, okay, well, you didn't get the money yet, but still the government wants to get interest on the tax that you would have paid had you gotten the money. So that's how a 453A and the installment sale works. And if you're listening to this and you do an installment sale that's more than $5 million as an exemption, you're going to pay the 453A tax, the interest rate applied to the 20% capital gains rate.
Yeah. Well, the thing I'd say there is perhaps you could use different trusts, non-grantor trusts, and maybe carve up your assets to get around that 453A. But that's part of a much broader conversation.
Absolutely. Yeah. There are ways around that.
I think it's also important to note that why does this work for us? And then because of the ESOP, you flip from ordinary income, because we were an S corporation, and so profits were taxed at ordinary income. And as I mentioned at the beginning, ordinary income cannot be offset by the capital losses that are generated from this investment strategy. However, because we did the ESOP, it's now capital gain. We sold the business, therefore we have a promissory note, an IOU, and it's a capital gain taxation. So now we're able to match our income with the losses that are generated from the strategy. That allows them to offset. Whereas if we were still an S corp and we did not do the ESOP, we most likely would not have been as drawn into the strategy, because sure, it would create some tax losses, and yes, it's been outperforming, but we may not necessarily be able to use those tax losses.
Yep, very true. And I think you said it just right, is that the ESOP, for those of you who have or are considering ESOPs, it changes the cash flow from ordinary income to capital gains. There are other benefits. There are other drawbacks. ESOPs are complicated. And as I said earlier, a lot of times entrepreneurs hear I do something, so they want to do it, and they go, I want to do an ESOP. I say, I know your situation, and ESOP does not fit your situation. So you want to make sure anything you do that you're making sure you're diving in with your professionals and your team to make sure it actually fits you and not just someone that you know.
Yep. But again, a great investment strategy, some great tax benefits. If you're going to have a liquidity event within your business, whether that's you owning capital interest, even if you're owning profit interest, or if you're going to sell any type of stock, any type of real estate, crypto, a really great tax efficient strategy that can help you get diversified and has been performing really well.
Yep. So definitely worth considering and researching.
Awesome. All right. Well, that's it for us, Jim, here today on this episode. I know we deep dived really in depth on one strategy here. So not a whole lot to choose from, but what are your biggest takeaways?
I'm always amazed at how creative intellectuals in this space are. I mean, to come up with these strategies like direct indexing. I mean, indexing has been a thing since I started in the business 30 years ago, and someone came up with the idea, how can we make it better? And they came up with direct indexing. And then someone else came up with, how can we make good returns and create more losses using that as a kind of a fundamental base of the direct indexing to do something even more profound. So I think that's my takeaway, is I'm always just amazed at how these really smart people come up with these different strategies and ideas. And then it's just a part of why this business is so exciting, because there's always something new you can learn, some new way that we can help our entrepreneurs.
Yep. I like it. I think my biggest takeaway really is this case study of this entrepreneur that has this $70 million LOI and the value of the foresight. Because like we mentioned, getting a business worth $70 million out of the taxable estate into irrevocable trust at a $6 million valuation, because we had the foresight of, hey, we're going to build this business to grow and have a liquidity event. So great estate tax mitigation strategy there. Great intergenerational wealth planning there. Right now we've got the dynastic trust set up. And now once this business or this deal is executed, we have really clear line of sight to creating multi-generational wealth. Now that doesn't solve the income tax problem, but that's where with the charitable lead trust, with this enhanced direct indexing strategy, going from an $11 million tax liability to maybe less than $1, less than $2, less than $3 million tax liability, as a percentage of the deal, it's going to be low single digits. That is how you make your money work hard for you. But like you said, you can't do this 30 days in advance of the deal. You've got to be willing to invest the time and the energy and the mental cycles and get your team rock and rolling on this years in advance to really do this well.
Yeah,
and
well
that's the hard
said.
part.
Well said.
Cool. All right, Jim. Good to connect with you. Good to see you. And I'm excited for 2026.
I can't wait to see your boys when I'm 90.
Yeah, they're going to have a lot of good documents for you, and they're going to be armed with a few different attorneys and some lace cookies.
I'm ready. I'm not worried. I might be ready to go. Maybe they're Maybe they're helping me go to
Oh, well, I wasn't thinking about that kind of
go to
lacing
meet
'cause
my
I didn't-
maker. I don't know.
I didn't want them to go get charged with murder. I was thinking of just like getting you
Oh.
high, like some weed brownies or something like that.
Wow, that's a whole different thing.
Well, yeah, I mean, I don't want them to go to jail.
No, good.
Yeah, I don't want them to
and
kill
I'm
you.
not a big weed guy. If you would have told me as a young person that one day marijuana would be legal in all these states, not just for medicinal but for recreational, I would have never believed you in a million years. And here we are.
Yeah. Well, now it's not just that. It's also now like they're incorporating it in TCH and like beers and stuff like that. Like there's, yeah.
I haven't tried
Taste
that
and
yet.
preferences are changing. Me neither.
I haven't tried that yet, but I still like mushrooms in my omelet. So I don't know if that's the direction they're going, but hopefully those will stay legal.
Well, I'm just shocked that you thought I was gonna. Well, I'm encourage my kids to murder you.
I didn't know. Hey, I don't know how much. I know you love your boys. Maybe you're like, hey, if I can get them a hand up, maybe. You're right. I should have more faith in you than to think that you would have your boys try to poison me.
I think we're gonna have to do some repair after this.
That's okay.
All right, Jim. We'll talk soon.
Good to see you.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Do Wealth Management, an SEC registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.